What do you say we do a live stream here, Jeff?
That's what we do on the first Fridays of the month, except when we don't.
That's right. And this time we're actually doing it. And this is 2 months in a row?
I think it is 2 months in a row. I also don't think we're live yet.
Of course we're live. We're absolutely live.
Now we're live.
So a little bit of making of the sausage here. There's two things that I can count on happening every time we do the first Friday. A few minutes before we go live, Jeff is going to say to me, I don't think we have enough things to talk about. We always have enough things to talk about. And then when it goes live, he's going to say, I don't think we're live. And we're live. So,
well, to be fair, in my defense, there were many, many months where you actually did not click the right buttons despite your insistence that you had.
Yeah, that was like when we first started doing the live stream over a year ago.
I'm just saying.
Okay. All right, fine. Everybody, hey, everybody that's watching us so far. And if you're listening to the recording on after Friday, glad you're listening to the recording. Would sure love it if you came to our YouTube and join the live stream if you could. Again, it's 4 p.m. Eastern on the first Friday of the month, except, Jeff?
Except when it's not.
Right. That's exactly right. So, all right, what's on the docket for today?
I mean, it's been a week.
Kind of, yeah.
So the last time I looked, the S&P 500 was down a little bit over the past month. So despite having some impressive up days thrown in there, it has not felt as crazy as it had maybe previously to this month. And this week, I think, is going to end down. I'm just guessing just based on what I remember from the last couple of days. I haven't actually checked that.
Yeah, I'm actually pulling it up right now to take a closer look and see. And I think if we go back to last Friday, the down S&P are down less than 2%, between 1.5% and 2%. And NASDAQ, that's where the pain really is. It's down since market closed on last Friday. It's down about 3%. If we look at it from the peak, when was the peak? We got to go back a little bit farther. It's down about 5%. Well, I mean, it bounced a little today. Yeah, it's down 4.2% from the peak a couple weeks ago. S&P's down like 2%, 2.5%. But the big thing, like you said, Jeff, is it's just a lot of volatility, even like intraday volatility, where the market might be up at the open and then closes down. What I've seen a lot this week, though, is that there were days when it was down a ton and then would claw back a little bit of those gains by the end of the day.
Well, it reminds me, I think it was Ben Carlson wrote a post on his newsletter a couple months ago about how the last time there was a big downturn in the market, people bought the dip. And that was like not the usual behavior you see. And so I wonder on these days when the market opens, it's immediately within the first half hour of open, if it's down 1.5%, I wonder if people are going, hey, market's down, buying opportunity. Let me buy some percentage, and it ends up sending the market back up over the course of the day. But yeah, today was one of those days when even midday last I looked before running some errands and getting home and stuff, it was down 1-ish%. And I think it ended just about even for the S&P.
Yeah, no, it's pretty much break even. It's funny. We actually did a show where we kind of talked a little bit about what Carlson was talking about. And I do think that there is a ton of evidence that we were on the way to a bear market in April following Liberation Day and the tariffs and all that kind of stuff. And retail investors stopped the crash.
Well, them and the taco trade.
What's that?
Them
and then the taco trade. But the taco trade followed that, right? It was it became really thematic after that. So I do believe that probably is happening, but I will stick to what I said before when we talked about it. Just because it's a thing people are doing right now doesn't mean it's going to be a thing that people continue to do for the long term, because I mean, most people still have good jobs. And I mean, we'll talk a little bit about jobs data and some signs, some kind of maybe cracks in the jobs dam, so to speak. But as soon as we go through a period where it's like clear that there are job losses and it's picking up and we get into like recessionary reality, people are going to get a lot more risk averse. I really believe that.
Yeah. I mean, so the thing we had on the outline to start the live stream off with was basically the same thing we start every month off, which is just like a vibe check on the market.
What's your vibes, bro?
Yeah. What's your vibes, bro? And what's interesting to me is what has sold off in this past week or two, because you've seen a lot of the AI tech stocks selling off. In fact, I saw on social media today, 4 or 5 of the big names we always talk about, NVIDIA, Meta, Microsoft, Amazon, are all up like only like 5%, 6, 7, 8% on the year now, compared, and they were much higher earlier. So what you keep hearing from people who pay attention to the market is it's the AI mega tech companies that are kind of holding the whole market up. And if we're starting to see cracks in that, I do wonder if what we saw this week is going to continue. But now that I said that out loud, because of course I have not bought any stocks this entire month, we're 7 days in. I haven't bought stocks in the past 3 or 4 weeks. And because I didn't buy anything this week when things were on sale, a little bit at least, I guarantee you the market will rip on Monday. And it'll be up 2% or something like that.
Yeah, I mean, it does seem like it's almost a guaranteed. Just for giggles, I'm pulling up some data. I'm a little curious to see over the past 5 days. So kind of this period that we've seen this week. So the NASDAQ 100 was down about 3%. So there's MAGS, MAGS. It's a Magnificent 7 ETF. Down 3.44%, right? So it tracks. There's a large cap ETF that is basically, it's essentially, it's an X. There's another ETF that's basically kind of like the S&P 500 without the Mag 7. And it was down about 1.2%, while the S&P was down about 1.8%, right? Largely, again, directionally, it's what those large stocks are doing that's going to continue to drive the market, and it's going to be very outsized in things like the QQQ, NASDAQ 100, that kind of thing. All right, vibes. Where's your head?
I mean, this week was encouraging for someone who has 20 years before I need to withdraw any of my invested money. I'm looking for downturns. So this week was encouraging in the sense that it feels like maybe I'll get some of the stocks in my portfolio at better prices. And it's just, I had the same feeling in 2020 and 2021, and it ended up happening in 2022, where it just feels not comfortable, right? Like things have run too much. There's too many things you can point to and go like, well, that's the top, just ridiculous behavior. I found this week encouraging, and what would actually, I think, be good for the market. I mean, it needs a correction. Market corrections are normal. They're never fun to live through, but like they're just a part of how the market works, whether it's a huge crash or just a withdrawal, a drawback of a couple percent. What's interesting is if we don't get an actual crash, but like, what if next week's just like this week, right? Down a little bit. And the week after that is down a little bit too. I wonder if there's a scenario where we look back and go, oh man, over the past 4 months, the market's down 3%, like rather than up 8 or something, like we've been living through in the past. So that's my vibes are sort of like this week felt like it was maybe a step in the right direction for the health of the market. But every time I have felt that way over the course of this calendar year, I have been met the next market day by some huge swing up and then like another bull run. So I'm not making any investing decisions based on my vibes right now. I'm about ready to buy something because it's been a few weeks and the money's in my account. I just haven't had actually the time while the market's open to sit down and make an informed decision. So we'll see what next week brings. But yeah, I'm not doing anything different, I guess, is how I'd sum it up. What about you? What are your market vibes here in the beginning of November?
Well, John Gallegos in our in the chat here reminds us, specifically you, Jeff, the market can continue to run higher.
No, I know. Yeah.
It does. I think Jeff, to your point, I guess the way that I'm thinking about what we're going through right now is really trying to more fully understand kind of the realities of everything with the AI infrastructure boom, right? So many people are saying that it's a bubble. I think it's a little groupthink that's kind of creeped in there, and it's like, let's kind of normalize calling it a bubble, and then everybody's gonna be like, all right, let's just invest in the bubble. But I think it is going to be one of the great wealth creating transitions in humanity's history, right? I really do. I think that's going to be the case. In the same way that the printing press and the steam engine, using combustion engines, and then the iterations from there, and the internet and the telephone, like every single one of these things that came through created disruption. Funny little thing that I heard that ties into this. I can't remember where I read it or heard it. I think I might have heard it on NPR, actually. If not NPR, it was maybe Planet Money podcast or something like that. That in terms of percentage of GDP, which is a useful way to contextualize
something happening 30 years after the last thing that happened.
What's that?
Something happening 30 years after the thing you're trying to compare it to.
Well, I mean, we're going even further back than that. Like post-World War II, like the mass market production of air conditioners, the build out of the electrical grid, like during that post-World War II period, as a percentage of GDP, was bigger than what's happening right now with AI, right? So we're talking 70, 60 years ago, right? So I guess my point is that it's easy to look at something like AI and immediately take it back to the dot-com bubble, right? Because it feels like the same thing. It's tech companies run rampant and investors with pie in the sky expectations that are not going to come to reality. And I would say that, like, looking back now, 25 years later, I think the internet has exceeded probably even the wildest expectations of a lot of people.
Okay, but I want to pause on that because this is where my head is on AI spend right now. I agree with you. Obviously, the internet changed the world, and so did the mobile revolution that came along after the iPhone was released. So let's call it 2007 to now.
Yeah. I mean, I think it gets really started like 2002, right? When the digital cell phones really started becoming a major thing.
No, I disagree. I mean, a little bit, but like not really. Like you couldn't like we're at the point now where there's almost nothing you can't do on a mobile device. That took a long time to get to that point.
Right.
Yes, mobile phones were...
There wasn't an app store when the iPhone came out.
Right. I mean, like you and I are around the same age, and we probably got cell phones for the first time around the same age. Like for me, like 18, 19 was like the first time I had one, but I didn't use it. I had like a limited minute plan, and I basically had it in my car for emergencies. It was not until probably 2001, 2002, where I had like a cell phone I would use to like regularly call people and text and things like that.
I remember that. Like you'd get a plan that was like 200 minutes a month and 29 cents a minute after that. Like,
and you'd only get like 100 texts a month or something.
Yeah. Yeah.
So anyway, we don't have to be
texts were
men.
impossible to send.
Right.
They were so hard to send because if you wanted the letter C, you'd have to press the number 2-3 times to do a C. Yeah.
But that's what I mean about like, yes, that was around then, but I don't think it really hit like revolutionary times until much later. Here's my whole point with the AI thing. There is part of me that wants to be the contrarian that says in 2025 that this is not going to turn out to be anything near what we think it is. It's not going to change the world. It's not going to be this fourth industrial revolution or whatever people are calling it. But I'm not naive enough to actually predict that. Like I do think over a long enough time frame, this has the potential to be as big as the internet, as big as the mobile, as big as the electrical grid build out in the early parts of the 20th century. But what if it takes a longer time than we think? And what if it's just little bits of incremental progress and not this big utopian moment where we hand over our lives to the AI overlords? Because I lived through the internet age. I lived through the personal computer in your house turning into the internet, turning into the mobile revolution. And there were points along the road where I would like see a new thing and be like, oh, that was pretty cool. Like, I didn't think that was a possibility. But there was not this moment where I went to bed one night and woke up the next and the world was different. And people are acting as if we are months away, or maybe even just a few years away from there being no more entry-level jobs.
Yeah.
You know, robots in my house doing my laundry, cars driving themselves, if not flying through space. Like, I just wonder if this is just a normal 25-year thing where like it's imperceivable progress over a very long time.
Right.
Is that
Yeah.
does that not match with the expectations we have right now? And does that not match with the AI spending? Like, that's, I think, the more likely scenario. It's that we look back in 2050 to now and say, oh, that was the beginning. But I don't know that we're like in 2028, I'm going to be relaxing on a beach while AI does all the work in the world and we're getting a universal basic income.
Or panhandling on the beach because the robots took away all the jobs. So no, I think the reality is probably going to be somewhere in between. But while I'm giving my thoughts, you should hop over to the chat there and answer Lou Whiteman's question. For those that don't know, Jeff will be directly at the end of our live stream. Will be on the Motley Fool's member live stream with Lou Whiteman, and Lou has come over to our live stream chat here.
Troll me.
To ask Jeff. But yeah, no, he is trolling us.
Yeah.
But
Lou, I've been putting plenty of ideas into Slack. And by plenty of ideas, I mean almost none.
Yeah, right. So Lou's ready to plan that live stream right here on our live stream. So I kind of love it. I think it's great. But no, I think the reality is kind of somewhere in between. I think there are certainly aspects of the way that more people are starting to use AI like in their lives, that I guess the way that I think about it is it's really accelerating the way that we interact with computers and the way that we can, the things that we can get computers to do in maybe easier, better ways, right? I've started using Gemini. I actually I just signed up for the paid Gemini LLM, and honestly, it's probably saved me 2 hours of work just in the past like 2 days.
So it saved you all of the work you do in 2 days.
Yes, that is an accurate way to describe it. But I think that we're going to see more and more of that. I've teased. I've kind of poked fun at Amazon because we're part of the test group with Alexa.
Yeah, I signed up for that too.
It's so much better than the Alexa from before. It learns, like it was doing some weird, I talked about, like it was saying metaphors as if they were truth. And I told it, why are you lying to my son? And it apologized for getting going too far with it and said that it would adjust. And that's cool, right? That's cool. It's actually learning in real time. So
it's also listening to everything you do without you knowing.
But yeah, no, well, I just said Alexa, and it's the one in the bedroom down the hall started talking to me. So, but no, I think it's
Jason, hold on a second. Let's have some fun with everyone listening to this. Alexa. Okay. We can move on now. By the way, if you're listening to this and what I just said actually triggered your device, please let us know.
Yeah. That'd be very, very funny.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks Podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks Podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
So, a few things that I think are true. I think we're going to way overspend because it always happens. This is capitalism. You know, you've got dozens and hundreds of companies that are all racing to get to the same market, right? All of their spending is not going to come to fruition. That is just a reality of a transformative technology, right? So it's a feature of capitalism, right? It's not a bug when it happens, and it's not a failure of capitalism. So I think that's an important thing to remember. But I do think there's going to be plenty of pockets of opportunity, even if we, whether we see this overspend happen for a few years or 5 years before like the inevitable fall off happens. I think what investors have to do, and what I'm really trying to do, is make sure that I'm exposed to companies where things like they're not putting their balance sheet at risk or fundamentally changing their business model in ways that if their AI ambitions aren't successful, it's really going to weigh on the company for a long time. I've said this about Meta. I'm really concerned that Meta is, of the Mag 7. I'm not even going to put Tesla in this conversation, all the other ones. That Meta is the one that if they're not successful with monetizing AI, they are blowing their balance sheet up, and they're gonna. It's an ad-based business. There could be issues with their ability to monetize that if we get into a weak economy, right? And the ad market tanks. We saw that happen already, right? Back in 2022, and it can flip their cash flows in a hurry, right? So I think making sure you're exposed to companies that like they're building for the upside, but their business models are going to be resilient. That's where I'm trying to stay focused.
I have a hot take.
Love hot takes.
All right. And this is what got me thinking about this. I'll give credit to Lou, our friend Lou, who was just trolling me. Lou is a believer that over some time frame, these LLMs that we're all using right now, Gemini, ChatGPT, Claude, Anthropic, Grok, if you want to throw that in there, they're all going to become commoditized. They're all eventually going to do around the same thing. They're all going to cost around the same amount of money. If that's true, is Apple the smartest big company out of all of them? Maybe their play is simply to wait and then license the technology. Even if they have to pay some ungodly amount of money to license Gemini on Apple devices, or license ChatGPT, or license any of them, it's going to pale in comparison to the money they would have had to light on fire to develop their own, proprietary large language model. And then all of a sudden, they've just put a really good developed AI that someone else put all that time and energy and money into a device that 2 billion people in the world use. Like if that's the route they go, and I got thinking about this partially because of what Lou always says about them being commoditized, but also there was an article rumor yesterday about Apple being in talks with Google about doing this with Gemini. I actually don't necessarily think that that's going to happen because they're already in hot water with regulators about using Chrome using Google as the default search engine on devices. So, but that idea of like, let everyone else burn the cash and just license the product is not the worst idea in the world if that's the way that they go.
I think so, but I think for me, when it comes to Apple, and I've said it before on the podcast that I do think Apple's well behind, and their closed loop hardware focus, proprietary software focus, that's been a feature and a major benefit. And it's, where I stand on moats, but I think they've made it a competitive advantage. and they've maintained it. It could be a risk, could be a really big risk, depending on how things play out with AI. But I also always come back to the fact that the iPod wasn't the first MP3 player. The iPhone wasn't the first smartphone.
They're not the first
Apple
to
Watch
anything.
wasn't the first smartwatch. Right.
Yeah.
They're never the first to market. They tend to be the perfecter. They're the best to market. When they bring their product to the market, it tends to be wonderful. The thing that concerns me though is that they really did flop their attempt at AI, right? Their first salvo at AI was pretty sucky. And they continue to fall further and further behind there. So it does feel like less like they're just making sure they have it right when they come to market, that it's something wonderful, and that they just haven't figured it out. And this is the thing that they're not gonna figure out in the way that the market is gonna consume it. And they may have no choice but to do something like what you're talking about.
And I don't know that they're really paying a penalty for being behind in AI, right?
Yeah.
That's what everyone says. Apple's behind in AI. The Pixel phones can do things that the iPhone can't. Guess what has always been the case? The Pixel phone can do things the iPhone can't
We've been
do.
hearing that for 15 years.
It always does. They're never the first of these technologies, but they sell a lot of iPhones. I mean, I think I saw the other day, I think iPhone sales, like they sell more in just iPhones alone than like, I don't know, I forget the company. I'll just pick McDonald's, but I don't think that was it. Like, more than like McDonald's total revenue.
Yeah.
Something crazy like that, right? So,
right.
All right, I want to get to some of the questions in the chat, Jason, and then we can pivot and talk about the portfolio contest, because we have to talk about the Q3 results. But got a couple questions here, a couple comments. One's directed at you from John Gallegos, asking you if you had an opportunity to listen to the Brookfield Asset Management earnings call this morning, and if you had any thoughts.
Yeah, I never listened to the Brookfield Asset Management calls or any of the Brookfield entities, Brookfield Corporation, Brookfield Asset Management, the operating subsidiaries. I never listened to their calls. I'll read the transcripts, usually like a few weeks after. But I mean, I did review the numbers, and another great quarter. They continue to accumulate assets. I think they accumulated like another $20 or $30 billion in AUM in the quarter. Earnings was up solid, really solid. Like their fee-based earnings continues to grow. For people that don't know, this is the subsidiary that's just the asset management business. And the reason it's so important to the whole Brookfield ecosystem is, so Berkshire bought a bunch of insurance companies to get float, right? That capital to invest, basically free perpetual capital. And banks, of course, your deposits, they get the cash and then they use that to lend out, right? So those business models. And there's a third model that's very tangentially similar, and that's asset management, alternative asset management. It's basically a flavor of private equity, but there's more to it than that. And Brookfield Asset Management has been one of the great examples of that over the past 25 years, really. A little bit longer than that, but really the past 25 years have been exceptional, growing to a more than $1 trillion in AUM, because what it allows them to do is to buy really big, expensive things with other people's money. And then Brookfield Corporation, which is the parent company, and then those operating subsidiaries like Brookfield Renewable and Brookfield Infrastructure, they get to take minority stakes, and they also get to earn fees by being the operating entity of that. So they get to make a little bit of money there. So they get to leverage other people's money to get involved in these really profitable cash cow opportunities. And that business continues to drive literally everything else about Brookfield that's successful. Connor Teskey, the CEO there, has done, I think, a great job. And having it as a separate company, even though it's still majority owned by Brookfield Corporation, the line of sight, like to the financials and everything, I think there's a little more transparency there. But no, I haven't looked at it. But I will tell you, this is a company that is right square in the middle of everything with infrastructure, and they have been for a very, very long time. I mean, they were buying timberlands and toll roads and things like that when that was like what we thought of as infrastructure. And for the past decade, they have been pivoting hard to energy, both traditional energy and also alternatives, and like modern infrastructure, like telecommunications and data. They're so good at being where the money is flowing, and investors, very, very, very wealthy investors and pension funds, and you think about like Harvard and these big endowments. Those are the clients for the Brookfields of the world. It's why I think that business model works so well, is because they've been so good at delivering results that those clients are looking for, that feeds everything else that we as little tiny retail investors get to participate in, just kind of go along for the ride.
Yeah, I owned one of the Brookfields for a very little amount of time when I was a brand new investor, and I've not bought any other of their subsidiaries since. I should maybe take another look at them. We got some new people on the chat here, Jason, names I have not seen before, so I want to give a shout out to them. One question from one of those new names, I think you'll have an answer to. Heard a conversation with Sentinel One CEO via Motley Fool recently. Where do you think it's not working for the company? What is the inflection point?
Yeah, I actually was one of the interviews. Me and Tim Byers interviewed the CEO. So what is not working? I mean, honestly, I think a lot of things are working really well for Sentinel One. They're in a position where CrowdStrike is so dominant, and CrowdStrike has been able to throw CrowdStrike is a little older, not a lot older. Sentinel One's about 10 years old. But CrowdStrike got to a larger scale and had better VC backing, meaning more money sooner. So they were able to throw a lot more money at engineering a product. So they're bigger and they have more things that they offer. So I think thinking through Sentinel One's opportunity and the things that are holding it back, probably honestly the biggest one that's holding the stock back is stock-based compensation. The dilution is extraordinarily high. And part of that's just because it's a smaller company. And if you look at the growth rates, its growth rates since last summer have been higher than CrowdStrike's. But CrowdStrike still every quarter when they report, the revenue dollars, the new revenue dollars, the incremental revenue, the total dollar number is a lot bigger. So they're still accumulating substantial market share. And it's just hard when you're, in an industry where there's one big winner that's already so established. The inflection point to me is going to happen really probably in the next 18 months, as they're getting to that point where the cash in the door starts to become substantially larger than your operating expenses. And you truly get to the point where you don't have to worry about relying on the capital markets to fund growth. You don't need to do a secondary offering. You don't need to take on debt. And then you start getting to the point where the cash flows are bigger than your operating expenses, including stock-based compensation, right? Because that's the big one. Like, you want to get to that point where like your real free cash flow is positive. I think that's the inflection point for me, because if you look at the valuation, I have been steadfast that the stock is really, really cheap, even with the dilution. If you look at the growth rates and the quality of the business, I was exceedingly impressed with the CEO. And I go into those interviews just like a stone cold assassin, just expecting them to do everything they can to put the big sales pitch and the charisma. Come on, you don't get to take a company public like this unless you're just charismatic as hell. You have to be, right? And I was expecting a lot more of like sales and spin. This was somebody that is deeply technically an expert in cybersecurity. And one of the things that he talked about as a huge opportunity is cybersecurity for AI. As these AI tools start getting rolled into more and more enterprises, who's guarding the AI, right? The data that people are feeding into those AI tools, that they might have no idea. The data may not be secure. So they see a tremendous opportunity there. He actually talked about that on the interview that we did. So I think the inflection point probably is just going to be just getting to another year and a half of scale, and the cash flows are going to be substantial enough that it's going to solve a lot of problems for the company.
One of the things I wonder about the cybersecurity space. So there's two things, right? We have companies that are well established and well known and big players, right? CrowdStrike, you mentioned, Zscaler, Sentinel One, and you can go on Palo Alto Networks. There's a lot. Fortinet, right, is an older one that I own. And there's two ways to look at the future. One is like there's not going to be less cyber threats, so it's like this ever expanding TAM, right? Like that. I don't see any way that it slows down, and that's good for all these companies. And so there's part of me that thinks over time we're probably going to see some consolidation. And maybe there will be a handful of winners rather than dozens of players in the space. But on the other hand, the CrowdStrike outage from last July or 2 Julys ago, I forget what year it happened in now. And even like things like the AWS outage that we had just a few weeks ago, I do wonder if those events don't make people think that these providers are no longer reliable, but maybe think to themselves, even though it's economically smart for me to buy more modules from CrowdStrike, I'm going to have these other things I need covered by a Sentinel One or a Zscaler or because I don't want a single point of failure, right? If God forbid the one cybersecurity company that runs all my cybersecurity has a huge outage or a breach, I'm vulnerable. And even if it's for minutes, that could be devastating to my business. So I have not followed Sentinel One closely, but I wonder if for some of these smaller, newer players still trying to get to that inflection point, I wonder if that redundancy that might be appealing to especially large businesses that can afford it might be a benefit to them and help them, gain share over time without necessarily seeing like a company like CrowdStrike like fall out of favor, right? It could be a big enough market that you could see several winners that all kind of define and are good investments. So I don't know the answer to that, but that's one of the things I wonder about that space.
Yeah. I think even if it's not a company that's choosing to roll out multiple AI products or multiple cybersecurity products from different vendors, I do think that there will certainly be plenty of companies that are looking at alternatives, because you saw like the outage last summer that was all tied to CrowdStrike, right? Sometimes being with the biggest company in a cloud space like that, it's like, yeah, I don't want to take on the risk, right? I want to be part of a smaller business that doesn't have as much exposure, as maybe not as targeted, right? But there's some really interesting differentiators that they have. Sentinel One has that I think could be really compelling. They also do have some tools specifically built, some of the things that they do with AI that are designed for enterprises that might be using CrowdStrike's endpoint in their enterprise, and they're looking for other things where they can actually integrate it together with tools that Sentinel One provides. So there will be some of that. I don't know how big that market's going to be, but I think the biggest opportunity is just going to be AI in general. It's creating law of unintended consequences. We got a question here about SanDisk. This is from somebody I haven't seen before. The housing specialist NYC asked a question about SanDisk, talking about the stock having recovered, hit a new all-time high. Asked any tips or advice. So we always put this out there. Please don't ever take anything we say as individual or personal advice directed at you individually for a million reasons. Number one, you could sue us and we'd be breaking the law. But mainly because we don't know anywhere near enough about your situation to advise what the right thing to do. But here's what I do know. I don't really follow SanDisk very closely, but I mean, this is another story of AI creating massive demand. SanDisk business, I think most people probably know they're the little SD cards, right, for digital cameras and that kind of stuff. They make solid state hard drives and NAND and flash memory and lots of things that go in servers too and PCs. That's probably a bigger part of their business than anything on the consumer side. And there's just massive, massive demand. If we did a little short, or that we cut from last month's live stream, that I think is kind of pointed directly at this. You were talking about going through the experience as a young investor, something that you learned. It's like, wow, I got a stock that doubled. That's incredible. Like that's the top of the mountain. And a lot of times the worst thing you could do with a stock that's doubled is sell, right? Right. Because you sell a double, you never get a 10 bagger, right? If you always sell. But you also have to consider, what is the downside? We invest to create wealth and then to use that wealth in the real world. And sometimes you have a stock that's been such a big winner for you, or you're getting close to financial goals. It's time to turn that stock back into money, right? It's time to sell some of it, part of it, all of it, whatever necessarily makes sense. We're in a situation right now, obviously, with the AI build out, that are we, 6 months away from the big tech companies pulling back, right? We're seeing all this stuff with job cuts. Most of those job cuts from the tech companies, Jeff, I think it's probably companies reallocating resources mostly to AI, right? So they might be cutting jobs, but at the same time, they're hiring people into those areas where there's opportunity. But at some point, the music's going to stop. And if your timeline and your financial goals as an investor line up with like the music stopping, you're creating risk for yourself. But if you're thinking in terms of decades versus just months or years, great businesses can continue to run. I just think for me, a company like SanDisk is a little bit in my too hard pile, because it's a commodity business at the end of the day. There's tons of companies out there that make solid. You got Western Digital is a big player in this space. On the memory side, Micron is a giant. And right now they're making a lot of money because there's so much demand. They're getting a little bit better margin because you're not having to fight so hard on the pricing. But how long can that last?
Well, let's say that the thing I keep thinking is it's cyclical, right? So
very much so.
You're going to be at some point with this stock, you're going to be on the other end of that cycle, and it's not going to feel as good, and you're going to be questioning what to do. And that's why, I agree with you. Like, these go in my too hard pile as well. All right. So let's pivot. Let's talk about the stock contest. If we have we have some new people in the chat here. So I'm assuming there are people who don't know what we're talking about. So every year for the past, since we started the podcast, we've done a investing unscripted portfolio contest. It has had different iterations in each year. This current year was the most wide-reaching and participatory one we've ever had. It's also so unwieldy that we'll never do it this way again. But we will finish out the year, and we have our Q3 winner. So we're all donating money. Everyone listening donates money to the winner's charity. And the winner for Q3, so this is just July 1st through September 30th. So this is not
Jeff, before you share the winner, just for those that are listening to the live stream right now, if you look in the chat, I just dropped the link in. You can click on it and you can view it. For those that are listening to the recording, just look in the show notes and you can find the link for it. So, okay.
So the winner for Q3 with a astounding 34.5% return is Saad. I don't know how to pronounce the name correctly, but I'll do my best. He was up 34.5%. Just by comparison, the S&P 500 was up 8.1% in Q3. And Jason, we had, 1, 2, 3, 4, 5, 6, only 7 of the 29 contestants, including you and I, actually beat the market in the third quarter. That's Saad, Brian, Lance, John G, Teo, Nicken, Casey, Rossalillo from Chip Stock Investor, and Timothy S. all beat the market. So congratulations to all you guys for having a nice quarter there.
Yeah, I mean, the S&P was up 8% in the quarter. It's a good quarter.
Now, what's interesting about the winning portfolio is, so he's only got one stock that's down, and that's Domino's Pizza. This is just year to date, by the way, I'm talking about right now, just because I don't have like the specific quarter results by stock in front of me. But year to date, Only Domino's Pizza is down for him in his portfolio. It's down 2.3%. Everything else is up. He's got 4 stocks that are up triple digits, another one up 93%, another 2 up 40 something percent. Like this portfolio was constructed perfectly for the first 9 months of 2025 for sure, because it has things in it like Oklo and Palantir. And
this is a YOLO portfolio.
This is again, like if you could have picked the perfect 2025 portfolio, this is it. So congratulations to Saad. The charity he chose, when he emailed me the portfolio back in January, I asked him, or in December, I should say, I asked him what charity he wanted. He said anything that benefits kids. So I decided to make the charity the Children's Hospital of Pennsylvania, which is also the charity that's on my portfolio. So if I ever actually win a quarter, that's where we'll all be donating money. So if you're listening live or recorded, open up your computer, go to Chop, and give some money to the Children's Hospital of Philadelphia. I have a family member who is a patient there when she needs to be, and they have done wonderful, wonderful things for her, and she lives a happy life because of the great doctors there. So happens to be the winning charity for this month, happens to be a charity that I'm a big fan of. So we're all doing it. That's how the game is played. We donate to Chop. But I encourage everyone, we're not going to spend too much more time on the portfolio. But if you're listening, it is in the show notes all the time. It's near the bottom, 2025 portfolio contest. Go ahead and click through it. It's really interesting to see the different ways that people have approached this. We have one portfolio that is one stock. So Caleb lives and dies by Upstart Holdings. We have one portfolio by Craig, which is basically an index fund. And we have everything in between. So now, Jason, here's the most fun part for me. Let's look at how you and I are doing year to date, because you beat me in the quarter, so we're not going to talk about that. But year to date, I'm up 21%, and Jason's only up 17%. So
That's true.
Just going to put that out there. And
I'll tell you too. It's the stock that I have that's done the worst. If you look at the sheet, you'll be able to see it. But I'm under disclosure requirements from the Motley Fool right now, so I can't talk about it. But like Enphase down 45%, I still have super high conviction in that. QXO is down 22%. I still think that there's a lot to like about that business. Sentinel One, I just talked about it. So I looked at the ones that I have that are down. Taj Homes, eventually the housing market is in the sentiment for home builders, I think, is going to recover. So the stocks that I have in the portfolio that are down, every single one of them, I would buy today. So I think that's an important thing when building these portfolios. I want to say this though, the 2024 Investing Unscripted contest, you'll find this in the show notes. You'll find the link to that one.
Yeah, because we keep all the old years going. So we're going to be looking back at 2023 and 2024 every year just to see where things are.
Holy crap. I will tell you, dude, looking at it, I have 1, 2, 3, 4, 5, 6, 7, 8 stocks in it. And one of them is filed for Chapter 11. Another one did a 15 for 1, a 1 for 15 reverse split. It's not a good thing. Boston Omaha is another one that's in there. Outset Medical. I would not buy these. I would not buy these stocks. Like I would not buy them today. Like any of those, I would not buy. I did what I thought was fun bottom feeding kind of thing when I built that thing. And I love that we're keeping that thing in perpetuity, Jeff, because it's such a reminder every time I look at it. Don't be stupid and try to like scrap up scrapes off the bottom of the barrel. Find great businesses that you love, buy them, and continue to monitor them and make them earn more of your capital.
So I want to keep doing this every year because I want to build on what you just said. So when I look at my 25 list, right? Everything in my portfolio, I still have actually pretty high conviction in. I went conviction for this year's contest. The ones that are down for me for this year, Kinsale Capital, I still have an enormous amount of conviction in that company. The space has got more competitive, but in the long run, they're going to be fine. If I had cash in this portfolio, you left some cash in, so you can still actually add to some of the stocks that you like. I would be buying more of this right now. PayPal, I'm still happy with the turnaround that they're going through. I think it's just taking slower than I thought it would. I actually added to PayPal relatively recently in my personal portfolio, so that's a stock I still have high conviction in. And Warby Parker is one of my newer stocks that I own. I actually put it in this portfolio before I owned it, I think. But anyway, I still have high conviction in that. It's a volatile stock. It's a newer, smaller company, so it's going to move around a lot. I would buy all three of those. Now, to your point, I look back at 2024, Boston Omaha, I have sold out of my personal portfolio. I no longer own it. So that tells you where I was with that. Still love CrowdStrike. Dreamfinder Homes, I'm actually thinking about if I want to keep holding on to that, but you'll have to tune into next week's podcast to hear more about that. EPR Properties, still like it. Outset Medical, pour one out. Still love that company. Down 90-something% in my personal portfolio. Procore, I have a high conviction in. That's actually, they just reported earnings, had a really nice Q3. Healthpeak Properties, no longer own it. It's a REIT. Progeny, no longer own it. And we just talked about PayPal, that's in that one too. So it's just an interesting mix for me because remember, I picked the 2024 portfolio 3.5 years after buying my first stock. Yeah. So I expect to see some bigger change as I go through this. If we go back to 23, Jason, which was our very first contest, and that was only 3 stocks each.
Well, that one, and that's the funny thing about it, because that we only did 3 stocks because we wanted to keep it simple. And what I did, now I want to be honest, there was some luck with the timing there, right? Because the beginning of 2023 was
the
a couple months after the market
bear
bottomed.
Market. Yeah.
Yeah. I mean, I think it bottomed in October. So it was a hella good time, right, to pick stocks that you had a lot of conviction in. But because it was only 3, I had to really focus on places where I had a lot of conviction. And CrowdStrike up 412%. Lemonade, which has gone ballistic, this year, up 448%. And then Trex is getting killed. It's down, 22%. So it's fun. I've got a stock that's down 22%, but the portfolio is almost a 4-bagger. It's up 280%.
Yeah. So I'm going to throw something out there to our listeners to wrap up this conversation. So whether you're new to our podcast or whether you've been listening along with us since we started it more than 3 years ago at this point, we have to do something differently in 2026.
Y'all are killing test people.
Even if we may not even do, we have to decide what to do, Jason and I. But if you have an idea for a way to do this, and there's been 3 different iterations that you can kind of go back and look at. Like one idea I have, Jason, I kind of want to bring back the unportfolio picks for me and you, because I did that wrong.
No, absolutely. That was a lot of fun.
I did that wrong. For those portfolio picks from 23 are some of the best performing stocks either of us have picked in our time.
So the unportfolio was essentially I don't want to say they were shorts, but it was kind of like we were shorting, right? We were picking stocks that we thought would do bad.
Correct.
I picked AMC Entertainment and Blink Charging, and they're down 93% and 86% since then.
Nailed it.
You picked Meta Platforms and Tesla, which are up 417 and 250%.
All right. So then I did it wrong. I was thinking more along the lines of, all right, 2 things. I actually did think they would struggle that year. I truly did. So this is not me completely hedging my choice. But I also picked stocks I wanted to do badly. I am not a fan of either CEO. But yeah, that was more of my emotions than my rational brain. But remember, heading into that year, Meta had just spent their first year of lighting Reality Labs money on fire, or maybe their second year, but it was before the declaration of the year of efficiency. So I was convinced they would struggle because I thought they could not continue to burn all that cash. Maybe if we do it for next year, I'll pick them again because they may be in the same boat.
Your timing might be pretty good. So I want to say here in the chat right now, John Gagos is doing the impossible right now. He is both patting himself. It's the elusive behind the back pat dunk. He's patting himself on the back for his performance in the contest while dunking on our friend Tyler Crow.
Yeah, I saw that. It's rough.
Yeah, it's pretty good. That's good, yeah. John. Love it. I'm here for it. Yeah. I'll give you a 9. I'll hold up a 9 for the dunk there.
There's one other fun one that I don't think I want to talk about right now because I'd rather do something different for the last couple minutes here. But there's a Smattering 6 contest. That's the one where we picked six stocks between the two of us in the episode that David Gardner was on, where we had him on back a few weeks ago. So that's another one that's in the show notes if anyone wants to check that out. It's not been that long. We'll talk about that more over a longer period of time, and we'll have David back on.
All I will say is the stock that I made a side bet with you would do the worst is the one that's doing the best.
Yeah.
So
yeah.
So LDP writes, what I do every 6 months is compare my convictions with their main competitors and see if they still come out on top, because I suffer too much from falling in love with the company and losing neutrality. That's normal, right? It's confirmation bias. We're all wired that way. So LDP, I love that. I love that little hack right there to help. That's a great framework thing, right? Frameworks helping you make better decisions and avoid bad decisions, creating friction between yourself and self-harm, like falling in love with the companies you own versus holding management accountable to making you more money. I love that. I think it's great.
Yeah, I like that a lot. I think a lot about coming up with some sort of process for me to kind of do a similar thing, right? Like whether I feel like I want to get a few things out of my portfolio or whether I'm starting to lose conviction in something. And again, little teaser for the episode we're going to record next week. So that will come out the week after that. To check that out because we're going to talk about similar things. But yeah, I keep thinking I want to come up with some sort of like process I put myself through, similar to what LDP just said. I just can never actually figure out what it is or bring myself to do it. But I've heard variations of this from other people. Like I know people who either don't have income coming into their portfolio sometimes have to do something like this, right? If you want to add a stock to your portfolio, you got to decide what one's going to go out because you don't have regular income. So that's a way to, put them up against each other and get a sense of where you have your actual conviction. But the idea of losing neutrality because you fall in love with a company, yeah, I'm guilty of that.
Yeah, that just makes you a person. So that's that's a game. All right, I have a fun little game here to wrap this up, Jeff. And I know you're going to have to go super quick because you've got to go to that other podcast, that live stream, What Pays Our Bills. So I have a couple questions, and this is touching on politics, but more thinking about the implications of the stock market. So what is the percentage of likelihood of a budget going through Congress to reopen the government by early next week? What do you think the likelihood of that?
All right, so this is the 7th. So you're saying like, let's say by Monday or Tuesday, the 10th or the 11th, something like that?
Well, let's say Tuesday. Tuesday.
Right. I think it's decent. Like we're closer to the end than we are to the beginning, I feel like. Although I saw a news thing right as we were coming on at 4:00 that there was a Democratic proposal that the Republicans shot down. I didn't click on the link, so I don't know what actually happened.
Well, of course, they said they're going to shoot the first one down. Of course,
I'll say that it's resolved by Thanksgiving.
That's way too far out. It's going to be resolved.
All right, by next Tuesday, no. I think by the end of next week, possibly. Give me to next Friday, and I would take.
I think the odds are favorable. It'll be open. Now. Here's the question for you: between now and it happening, is the market going to be up or down?
Down.
Okay. All right. So tariffs, Supreme Court.
Okay. I have a take on this. Ready?
Okay. Make it quick.
That's
rich coming from me.
Yeah, right. If the Supreme Court shoots them down, I think two things will happen. The market will rally immediately and bigly, and it will sometime in the shortly after, Trump will announce new tariffs using some other method, not emergency, 100%. And then we will go back through this whole up and down reaction cycle again. It'll just cause more uncertainty, more chaos. What's more interesting to me is if they don't strike them down and they leave them, and this is where I'm not so sure. I'll ask you, Jason, do you think there's a market reaction, significant one, if the ruling is, nope, they're good to go, keep them?
Yeah, if they're kept in place, the market's going to fall.
I feel like it's priced in. I feel like keeping them in place is priced in.
I don't think so. And the reason why is if you look at the betting markets and you look at the poly market, the odds have shifted. It's like 60% that they're going to be ruled either illegal and or unconstitutional. And those are two different things. I'm not going to get into specifics because we're almost out of time here. But like I think the market will fall if they are ruled. I think what's baked in is an expectation that they're going to get taken off the table. So yeah,
maybe.
But I think you're
so
right.
That's interesting because maybe that's why we haven't seen the downturn we all expected since April.
No, I do. I think that's the case.
Here's one more last minute. If they're overturned, if they're ruled illegal or unconstitutional or whatever, I know that the president's going to try to find another way to do them. But in the meantime, do you think any of the companies or importers that have paid them get any money back?
Yes.
Or is it impossible?
No, it's going to be a giant mess, but there will be lawsuits to get that money back. So as of right now, just the parties in the suit would get it back. So there's thousands and thousands of counterparties right now.
Yeah,
so
yeah.
I think so. I think so.
Right. 5 o'clock.
All right, friends. Thanks for joining us. This has been great. Jeff, you can go ahead and sign off. I'll turn off the lights and I'll shut everything down.
All right. Peace out.
This has been a lot of fun. And thanks for everybody that came. If you're listening to the recording, be sure to come back next month for our first Friday live stream, 4 p.m. Eastern, the first Friday of the month, except when it's not. We'd love to have more folks join us live. As always, just a reminder, we love to give our answers to your questions. But our answers they're our answers. You need to make sure you find the right answers for yourself. Even when Jeff's not around, I still believe that you can do it. All right, everybody. We'll see you next month.